Thank you, everyone, for joining our discussion today. My name is Apattanaik, and I'm an investment advisor here at Sprott. For those of you that have not attended one of these discussions before, I started this Q&A series with Rick last summer to address some of the common themes that we were being asked about by investors that were reaching out to us. And so the scope and the direction of these discussions are in a large part guided by those themes. One of my jobs as an advisor at Sprott is to help investors understand both sides of the risk spectrum. And in keeping with that obligation, I also try and steer these discussions to reflect both sides of the narrative. Rick, before we begin our discussion today, since we are a few weeks away from the 2021 Natural Resources Symposium, can you perhaps give folks a brief update on what to expect there? And also, what is your single favorite part of this conference?
An update to be sure, Aditya. I'll try and keep it brief, which will be a challenge for me. The conference is about 20 years old, and through various incarnations, we've tried to make it the single finest natural resource-oriented investment conference in the world. The consequence of that is that there are many moving parts that I think we've managed fairly well. In the first instance, the macro, both political and economic backdrop, has always been covered by our keynote speakers. It might be Nomi Friends, might be Danielle DiMartino Booth, Doug Casey, Jim Rickards, people who are familiar with global macro in a way that I think states well the underlying themes that would make one a natural resource investor. Probably more importantly, we've done a great job of covering where the rubber meets the road, which is to say, after we've developed the strategic reasons why one would be invested in natural resources, we've done a good job over 20 years of teaching the tactics, teaching the techniques, be it geological or be it financial, as an example. Probably more importantly than that, our attendees told us many years ago that they considered the exhibitors at the conference to be content too, not merely advertisers. At most investment conferences, the qualification to be an exhibitor is a pulse and a check that cashes, usually in reverse order of importance. At the Sprott conference, every exhibitor has to be owned. It's no longer the Sprott conference, pardon me, at my conference. Every exhibitor needs to be owned either in my managed accounts or the managed accounts of managers that I have an interest in, like the Sprott managers, which is to say that not necessarily every stock will go up, but we certainly have vetted them because we have our money invested in them. I think those are all important attributes. As to my favorite part of the conference, for 20 years it's been what I call the Living Legends. In the Living Legends program, we invite people to speak and subject themselves to questions. And to be qualified, one needs to have built a multi-billion-dollar company, or better yet, 2 or 3 multi-billion-dollar companies from scratch. The idea isn't merely to talk about their success, but rather the lessons that they learned in achieving that success, how those lessons makes them better investors for their own portfolio, and how the lessons that they've learned can make you a better investor too. The information that thousands of attendees have received over 2 decades from more than a dozen living legends, I think has literally been invaluable. I'm myself convinced enough about the value proposition offered up by the Natural Resources Investment Conference that if you decide to sign up for it, assuming that you are not yet a Sprott client, and pay the $299 admission fee, if for any reason you don't think that you've gotten your money's worth, I'll give you a full refund. You could short-circuit that, of course, by becoming a Sprott managed client, in which case I and Sprott will pay your admission fee for you.
Irrespective of how that decision goes, if you decide to come to the conference and you think for whatever reason, which I think is highly unlikely, we will refund you your admission. I think we've had to refund 3 admissions in 20 years of making that guarantee. But thank you for the opportunity, Aditya.
Okay, so let's get started with the discussion today. I want to start with your view on what it means to be a contrarian resource investor today, especially given some of the recent trends that we've been seeing in commodity prices. You've often remarked about the need to be a contrarian investor in capital-intensive businesses where sustained periods of misinvestments by companies cause commodity prices to overshoot in both directions. I remember a conversation we recorded last summer where we were talking about this, and you mentioned Steve Sugarroot's mantra of buying commodities when they were cheap and unloved, but also in an uptrend. Now, over the past year, commodity prices have rebounded sharply from their bear market lows. But at least in my opinion, the moves, which in a large part have coincided with some kind of narrative, be it the stimulus, supply disruptions due to COVID, the greening of the world, or inflation, the moves have had the characteristics of momentum money looking for a new home. Investors who've traded the momentum have come out ahead, but some of this momentum is now getting undone, and I think folks are starting to question some of these trends. One of my blind spots over the past 12 months has been what the liquidity can do to move an asset class or a stock simply based on momentum in very distorted markets. So I have 2 questions to kick off this discussion. The first question is, have you revised any of your macro frameworks in the commodities space in view of the liquidity in the markets today, and also some of the discussions that are being had around inflation? And the second question is, have any commodities moved up or down in terms of attractiveness, given the moves that we've seen over the last 12 months?
First of all, I would suggest to you, Aditya, and listeners, that contrarian investing and momentum investing are polar opposites. The basis of contrarian investing is buying things when they are cheap and unpopular. The basis of momentum investing is behavioral, which is to say, piling on to circumstances where the narrative attributes are well known and becoming popular. Warren Buffett has authored a couple famous phrases that put contrarian investing into context. The first is, of course, him saying that he made his fortune by being brave when others were afraid, and afraid when others were brave. The second, less well known, was that you make money by buying straw hats in winter when there's no market for them, rather than in summer when everybody wants one. In terms of the resource business, as we've talked about in prior interviews, what you look for, if you are lucky and disciplined, is a market where the median selling price of the commodity worldwide is below the median total cost of production worldwide, which is to say an industry where the price has to go up or the commodity will become unavailable. Mercifully for us, Aditya, a year ago we had numerous commodities that were in that position. Agricultural materials, which is to say potash and phosphate, uranium, oil and gas. The upticks that you have mentioned in industrial materials has made the opportunity set somewhat less expansive, but attractive still. In terms of your question, revisions, what has changed? For me, what has changed has been my allocation. A year or a year and a half ago, the very small companies, less than $300 million market caps, were abandoned and forgotten orphans. And because of inefficient distribution of information in the market, the junior companies were much cheaper, even on a risk-adjusted basis, than the major companies. I would suspect that because the market is currently oversupplied with capital, and by that I mean all markets, and increasingly narrative-oriented, the junior resource companies, which is to say the small caps and the micro caps, have increased in price to the extent that their attractiveness relative to the mid caps and relative to the majors has been diminished. One example might be in the uranium business, where the uranium juniors as a group are probably up by 200 or 300%. This is problematic because the risk hasn't decreased particularly, but the reward has decreased spectacularly. It's one thing to enjoy a 10-bagger on a $25 or $30 million market cap stock. It's an entirely different thing to enjoy a 10-bagger, which is the type of reward that one must hope for, taking high risks, on a $100 million stock or a $150 million stock. It's important to note, too, that even as the prices of these companies have doubled and tripled, the share counts have increased rapidly as a consequence of them doing financings. So, there's been a real challenge. Conversely, the major mining companies in the uranium space, I think, exhibit at least as good reward potential as the juniors. Meanwhile, they pay you a dividend and they generate less risk. So what's changed for me, really, Aditya, has been the way I allocate to the opportunities in the sector. And I'm sorry, with that long-winded answer, I forgot the second part of the question.
The second part was, have any commodities moved up or down in terms of attractiveness?
So, I mean, certainly gold and silver have become more attractive to me as the price of gold and silver has fallen and as the price of gold and silver equities have fallen. I don't believe that the fundamentals for gold and silver have changed very much at all, although the reckoning may have been postponed. Certainly, the economic climate that we see today with superb liquidity and very high consumer confidence has allowed the Federal Reserve to allow the interest rate, the nominal interest rate, at least on the 10-year Treasury, to increase from 60 basis points to 150 basis points, meaning that disintermediation out of credit products and into gold and a lack of confidence in the U.S. dollar is not manifest at present. But I believe that precious metals prices trade higher because of quantitative easing, which hasn't stopped, because of debt and deficits, which show no signs of even slowing down, and because real interest rates, which is to say the yield on the 10-year Treasury after the 4.5% depreciation that the Congressional Budget Office says we're seeing in the currency, because real interest rates are still steeply negative. I believe, as a consequence of that precious metals will resume their upward march. I believe that we are in a cyclical decline in a secular bull market. And as a consequence of that, gold and silver have become more attractive to me relative to other asset classes rather than less attractive. The other big call that we had a year ago was oil and gas, when the oil price was at $20 a barrel or $30 a barrel. Certainly with oil at $60 or $70 a barrel, it justifies the cost of production. But if you believe that the oil price is going to stay between $65 and $70 a barrel, the oil stocks, either on a net present value basis, depending, of course, on the discount rate you use, or on a free cash flow basis, are still very, very cheap. I kick myself for, in March of this year, as an example, missing the Exxon trade, where the oil narrative went negative and the stock got kicked out of the Dow-related indexes. But I think you can make up for that sin if you believe that today's oil prices are going to rise by buying a basket of high-quality, mid-cap Canadian oil and gas stocks. For those of you who want names, call Aditya. He's got them.
Do you think this is the start of a secular uptrend for the commodities group?
I think it depends on the commodity, frankly, Aditya. I think, as an example, iron ore is probably very fully priced, although there are still shortages in some grades and some compositions of iron ore. But the iron ore rally has been very, very long in the tooth for 4.5 years running. Supplies are increasing fairly rapidly. And as Vale comes back online, for those on the call who don't know, Vale is, if not the world's largest iron ore producer, one of the largest iron ore producers, and they had a hiatus in production at several mines as a consequence of the tailings dam collapse. As Vale comes back online, I think pressures in the iron ore business will be extreme. On the other side of the equation, for those of you who have the courage, it's tough to find a pure play, but the coal business looks extraordinarily attractive. I realize that Trudeau doesn't like it and Biden doesn't like it, and, you know, whatever that young woman from Sweden's name is doesn't like it. But it's very, very, very cheap. The truth is that markets are all over the place. And so I wouldn't be prepared to say that in terms of non-precious metals, natural resources, that we are in for stair steps to heaven. It wouldn't surprise me to see the economy that we are enjoying right now, which I believe is liquidity driven, begin to falter. After all, we had a 10-year recovery from 2009 to 2019 that was driven more by liquidity than anything else. And I don't think as a society we probably fully digested the economic harm done by the global economic shutdown around the COVID-19 virus. It could be that the incredible injections of liquidity that we're seeing into the market and the artificially low interest rates paper this, paper the need for a sort of a hiatus over. Certainly, Aditya, if you look further forward, if you look 4 years out or 5 years out, there will be consequences to 2 or 3 decades of underinvestment in primary resource exploration, in primary resource development, in sustaining capital investments, and there will be a price to pay too for resource nationalism, which reduces investment and reduces efficiency, and for simply the sort of delayed reaction to insufficient investment over time, which is to say that I believe a whole group of commodities, copper, nickel, oil, gas, will all experience production shortfalls, and the price will move not as a consequence of rapid increases in demand, but rather as a consequence of rapid reduction in supply. Whether that rally, that bull market gets underway in earnest sooner rather than later is something that is above my pay grade. I am long the very high quality producers in most industrial materials because I feel that I can afford to hold them through a downturn, given the value proposition, given the upside 3 or 4 years out, and given the fact that they're high dividends in a low interest rate environment obviates the time value of money argument against them.
On the topic of gold, and I get a lot of questions in the companies that you like the most, but the aim of this call is not to give stock tips. So I don't want to necessarily talk about specific companies that you like, but the other side of that question is the criteria that you use to identify those companies. I thought it would be instructive to use one of the companies that I've seen at the top of the ranking pile since I got involved with helping you out in the rankings. And this company has been there for almost 2 years, and it's almost always been the only 2 ranked company in the list. And that company is Polymetal. Could you perhaps use Polymetal as an example to illustrate why that stands out to you over all the other miners out there?
Yeah, what companies that get a very, very, very high ranking from me normally exhibit several traits. I want a preponderance of deposits in the companies. In other words, I want most of the revenue, either existent revenue or, in rare cases, undeveloped project revenue. I want the properties to be tier 1, which is to say in situ recoverable reserves and resources exceeding $10 billion in value. I want the return on capital employed associated both with the projects and with the company, that is to say, across projects, to be at least in the top quartile worldwide. And I want the costs, at least those that are determined to be AISC, all-in sustaining costs, to be in the best quartile worldwide. So I want a good asset allocator, and I want a low-cost producer. In addition, I want a good project pipeline. It's important to remember that sometimes companies that exhibit very high profits are exhibiting very high profits because the expenses that they're making associated with exploration or development are very low. They generate a lot of cash because they don't have anything to generate it on. To spend it on, pardon me. And those companies are ticking time bombs in the sense that what you're doing is reducing your capital in the company in the guise of profits. So I want really, really, really good product pipelines. Importantly, too, what I want to know is why the stock is underpriced. What is wrong with the company in the eyes of the market? In the case of Polymetal, that's pretty simple. They're in Russia. And people are afraid of Russia politically. They're afraid of the court system. They're afraid of the opacity of some aspects of Russian reporting. And I am too. In this particular case, the big Russian gold miners, be they Polymetal or Polyrus, are so cheap relative to their peers elsewhere in the world by any metric that is important to me, that I feel that the discount that the market applies to them is unwarranted.
I pulled up some stats here. So they have an all-in sustaining cost of $850 per ounce of gold. They're trading at an EV over EBITDA of 7. They have 10 years of reserve life at 4 grams per ton. And they have 9 mines operating in Russia and Kazakhstan. It's certainly an outlier from an asset-based perspective. The question, of course, is does that discount ever go away given the political risk associated with something like this?
And I think one attribute that you forgot to add is that the reserve life index is short relative to the resource. They haven't felt the need at 2 of their deposits to prove out reserves beyond 10 years because they didn't feel that the net present value of the current expenditure on a cash generative basis mattered. So when you talk about a 10-year reserve life index in the case of Polymetal, what you're talking about is an artificially constrained reserve life index because they haven't bothered. It reminds me very much Aditya, of investing in the famous Mexican silver miner, Peñoles, in the 1990s. In the 1990s, Peñoles had a reserve life index of 1.5 years. They had that because Mexico imposed a wealth tax. And to the extent that Peñoles drilled off their deposit better and extended the net present value, proven net present value of their deposit, the Mexican government would penalize them for their hard work by taxing those reserves at 2% a year. So if you looked at the geology around Peñoles, you could see that their principal deposits, in particular Fresnillo, had 30-year mine lives that were being expressed as 1.5 years. The same circumstance exists with Polymetal. In their big deposits, given the fact that they have what in oil and gas parlance would be 10 years of proved, developed, producing reserves ahead of them, they feel under no pressure whatsoever to drill the resources off to reserve standards. But when I look at the potential reserve life indexes around Polymetal, based on the drill densities that I see in the resource category, I see a reserve life index of more like 25 or 30 years.
As an alpha investment today, given where we see the market going, given that we see supply shortages, what is your opinion on companies that are essentially starting the process of building out their mines. Single asset companies, they've secured financing and they will be producing gold and returns from that gold in 2 years when we're likely in the middle of this gold bull market. What is your opinion on companies of that profile?
Certainly, speculating in those companies involves doing more work because you are taking more risk. Single asset companies are always undervalued relative to producing companies because they have greater risk. If something goes wrong in their one source of revenue, the company blows up. Whereas a company that's producing from 3 or 4 mines has greater stability of revenue and greater stability of earnings. That being the case, the very fact that they're ignored by large parts of the market due to the risk creates an opportunity. If the discount upon successful commissioning, which is to say post-construction, if the discount on a single asset producer gets too great, the market takes care of that because a multi-asset producer with a lower cost of capital, i.e. a higher share price, will try to take them over. If a single asset producer is taken over by a multi-asset producer, the reason for the discount disappears simply because it's put into the portfolio of a multi-asset producer. Our mutual friend, formerly Louis James, now Lobo Tigre, has published extensively on the fact that once companies are permitted and financed to development, when they're in the construction phase, that construction is regarded by most speculators as boring, and the market goes into hibernation, both because the process is boring and because there is construction risk that many people don't recognize. Upon successful completion, upon economic completion, and even sometimes in anticipation of successful completion, there can be strong repricing of these companies to the upside. I try and anticipate this. I try and look at circumstances where perhaps, as a consequence of my being a lender, that I understand the risks associated with the construction phase fairly well. And when people are either too bored, or too afraid to speculate in these stocks, when there's no motion in them, when there's no momentum in them, but when the values exhibited are the greatest, I try and focus on names like that.
Now, I want to switch gears to talking about something that people are not bored of at the moment as a commodity. We've seen a huge level of excitement in the space, which essentially went from obscurity to being on the tip of everyone's tongue, and that is uranium. And I had a lot of people writing into me with one very specific question about the uranium sector. Before I get to that question, I want to give people a little bit of a brief background on uranium prices over the last 50 years. We've essentially seen 2 bull markets in uranium over 50 years. In the 70s, there was a 5x increase in prices, and in the 2000s, there was a 12x increase in prices. The reasons were very different in both these periods. In the 70s, you had inflation, but you also had expectations for a significant increase in generating capacity. You had concerns about lack of enrichment, changes in expectations for uranium reprocessing, and you had an international uranium cartel at play. In the 2000s, we were in the midst of the commodity supercycle, so there were growth expectations, but there were a lot of extraneous factors as well, like low inventories, unexpected supply interruptions by mines getting flooded, and the emergence of hedge fund purchases. Some of these conditions today are actually quite reminiscent of both of these periods in time, but there are some fundamental differences. What are some of the catalysts that will get you back into the uranium equities? I know we spoke about this at length recently.
Aditya, I'm dying to get back into the uranium space. I mean, my big holdings now are Kazatomprom, CGN Mining, and Cameco, which is to say the big guys. The part of the market that I've always enjoyed the most are the little tiny guys. But the little tiny guys move so far so fast that what will cause me to come back into them would either be a repricing in yellow cake, which I think in the near term could only come as a consequence of an increasing pace of Japanese restarts, or what I actually hope happens, a wholesale decline in the prices associated with the uranium juniors. I'm still a holder of the uranium juniors, although I have taken profits in virtually all of them that I owned, but I'm still a holder. And the truest mark of affection, Aditya, for a sector is where you're a substantial holder in the sector and you hope the price declines so that you can buy more using the same intellectual capital that you've already spent understanding the market. It's odd that many people consider themselves to be a contrarian, but they need recent price action to justify that sort of bullish, sentiment. If you like something at $2 and you see it going to $6, $2 isn't the same as $6. But if you like it enough, if it falls from 6 back to say 250 or 3, although the price has fallen by 50%, it is arithmetically precisely twice as attractive. So the thing that would see me turn back to the Rick rule that you talked to 2 years ago, where I was an unconstrained bull on the uranium juniors, would simply be the price point. I've done probably a self-defeating thing in telling audiences about the Paladin story, about a stock that went from a 10-cent number to a $10 number, having gone to a penny from 10 first, by the way. Instructive lesson there. And you get people's greed very, very, very riled up when you talk about 10,000-fold returns. What you forget is that the beginning market cap of Paladin was 2 million Australian dollars, 1.6 million US. You aren't looking for 10,000 to 1 returns if you're starting off with a $250 or $300 million market cap. So it's important that people pay attention to the market capitalization and the enterprise value so that they understand, first of all, what the probable potential upside is, but also what the downside risk is.
One of the things I've noticed in your presentations on social media is you always qualify it with time, and often it's always 3 or 4 years over which you experience the gains that you did, that you were discussing. The single most important thing that I think I have learned from our discussion is about playing the long game and thinking about time value of money in the context of the long game. What is your advice to investors as we're almost running out of time? So as a closing statement, what is your advice to investors with regards to time value of money?
From a speculative point of view, I only want to point out to the audience that I have been profoundly lucky, more lucky than, 99.9% of speculators. And that's happened precisely because I orient the time that I allow my investments to mature with my own time horizon. In the vast majority of tenfold price escalations that I have enjoyed in my career, the total elapsed time to enjoy that tenfold price appreciation has been 5 or 6 or 7 years. Now, a 10-bagger in 5 years is a pretty astonishing internal rate of return. But there have been periods of time within that 5 years where the stocks did nothing or went down. And that's the second thing I should point out. I did a study of my own investment experience with Ross Beatty, who has delivered me 12 10-baggers in 35 years of investing with him. And in each of the 12 10-baggers, not only did the total elapsed time to get my tenfold return exceed 5 years in each circumstance, but in each circumstance, during the period that I held the stock, it fell by 50%. In 8 of the 12 cases, the share price fell by 50% twice during the holding period that was required for me to enjoy a 10-to-1 return. So in the first instance, the amount of time that you allow yourself in your portfolio to experience a 10-bagger has to coincide with the amount of time, it takes the management team to create the value inside the company that causes that return. But the second thing is that you have to have the courage of your convictions. You have to know enough about the stock that if it goes from $4 to $2, you're delighted so that you can buy more. And those are tough tests for people who aren't willing to do the work, both the psychological work and also the financial work that backs up the investment or the speculation.
Final closing comments, Rick, before we end the call today.
Well, I think it's been a very useful call, Aditya, and I want to thank you for causing it to occur. I guess I have 2 closing quotes. The way that you position yourself in the investment landscape changes as the investment landscape changes, and we've illustrated that a couple ways today. There was a point in time when there was no narrative in natural resources at all, and the consequence of that is that the speculative names had no audience at all, and they were cheap. As the generalist investor has come to become more interested in the natural resource space, for the first time in my life, and I suspect it's because of social media, the narrative around resources went from the biggest and the best companies in the world all the way down to the most speculative, and they became overpriced relative to other asset classes. If you allowed yourself and your behavior to be led by prior bull markets, and you ignored the relative valuations among various asset classes, you would have exposed yourself and would be exposing yourself today to far more risk than should be the case. When we talk about uranium today as an example, I can think of several, in fact I can think of a score of uranium juniors that would triple or quadruple at $65 or $70 yellow cake. But I believe that Kazatomprom could triple too. And the idea that I can get the same share market performance with markedly less risk while enjoying a 4.5% or 5% dividend, that sort of truism exhibited by arithmetic is the way that I think that investors have to view both this market and the strategies that are appropriate to their own portfolio in this market.